welcome to today's class. You are welcome to today's class. Please kindly mute your mic as you are joining. Yeah, we're just gonna give the rest like 4 minutes before we start, so no one draws us back or slows us down. So I'm sorry, though was supposed to be class yesterday, but due to some technical issues, class couldn't hold yesterday. So today we are going to be looking at margin. We're also going to be looking at equity. We're also going to be looking at the concept of um, take profit, stop loss, and most importantly, um, what is order type. There are different kind of order type that we have in the market, so I'm going to be explaining that in this section. So I hope we all have our tools and writing material, because you need to jot things down. As a forex trader, you need to jot things down. So we are going to start with margin. So what is margin? In forex trading, margin is a fundamental concept that refers to the amount of money a trader needs to deposit with their broker in order to open and maintain a trading position. So I'm going to come again. In forex trading, margin is a fundamental concept that refers to the amount of money a trader needs to deposit with their broker in order to open and maintain a trading position. So let me explain what margin is. Margin is the capital that you deposit with your broker, the amount you deposit with your broker. So that is what we call margin. So if you check your MT5 or your MT4 app, both on mobile app and on PC, so you see that there is a section there that you see margin. So the margin is where is your capital that you have. So that's what you call margin, and it's the amount, is the money that you deposit with your broker. So that is your capital. So that's what margin is. So we are going to be looking at leverage and margin. Leverage, like you all know, I've explained leverage before in the previous section. Leverage is the ratio is the ratio of the size of your position to the margin required to open the position. I will come again. Leverage is the ratio of the size of your position to the margin required to open the position. It is a powerful tool that allows trader to control larger position with a smaller amount of capital. So like I said before, leverage is like, it gives trader the ability to open multiple position with a smaller account size. So if you can choose to use an unlimited leverage, or you can choose to, the more leverage you use, the more your account can make a lot of profit, but it also expose your account to more risk also. So it has advantage and it has disadvantage. So we're going to look at margin level and margin call. So margin level is a ratio of your account equity. If you are just joining, please mute your mic, please. Okay, let me come again. The margin level is the ratio of your capital account equity to the used margin. I'll come again. The margin level is the ratio of your account equity. Sorry about that. I had to do one or two. So I'm going to be talking about managing risks with margin. So why leverage can amplify profits, it also can increase a potential larger losses. So the same way leverage can give you enough profits, can also give you a lot of losses. So you should know that while choosing the amount of leverage you want to use. It is essential to use leverage wisely and manage risks effectively. Using too much leverage can quickly lead to significant losses if the market moves against you. I said this before. You can use leverage. At times it might play out well, but if the market moves against you, I promise you, you are going to lose a lot of money because you are using more than your account can hold. So you are risking more than what your account can accommodate. So it can either give you money or you can lose money. And if you are losing, you're going to be losing a lot of capital and money. So you need to use leverage wisely. Let's just look at a key takeaway. Like, let me just summarize the whole thing so you can jot down. Number one, margin is a deposit required by the broker to open and maintain trading position. I'll come again. Margin is a deposit required by the broker to open and maintain trading position. Number two, leverage allows trader to control larger position with a smaller amount of capital. I'll come again. Leverage allows trader to control larger position with a smaller amount of capital. Okay, the third one, margin level indicates the ratio of equity to used margin. Margin level indicates the ratio of equity to used margin. So the fourth one, margin calls can occur if the margin level falls below a certain threshold. Margin call can occur if the margin level falls below a certain threshold. Like I said before, if you are in a trade and the trade goes against you, let's say you did not set stop loss in your trade and the trade goes against you, so what you are going to experience is if the trade keeps going against you and your stop loss is increasing, and then the market does not see money to still keep your trade active, it means you have blown your trading account, and then you are going to receive a call, a message from your broker that that you have no money again to trade and your account is blown. So that is margin call. And then the last one here on the summarize, effective risk management is essential when using leverage and margin. Effective, you are welcome, you are welcome. Please kindly mute your mic, please. You are welcome, please kindly mute your mic. Grace, you are welcome. Please kindly mute your mic. Okay. I don't think you are paying attention. So let's just move forward. So I'm going to be talking about equity. I know some of you could have heard about the word equity. So the definition of equity. Equity refers to the amount of money a trader has in his trading account. Let me come again. Equity refers to the amount of money a trader has in their trading account. So this is the amount of money that you have in your trading account. So before I said margin call, I said margin call is the amount of money that you deposit with your broker. So while equity is the amount of money that you have in your trading account. So let's say you deposit an amount of money with your broker, that is the margin. Then you now took a trade and the trade is now in profit. So now that trade now that is in profit, that is your is your equity. It's gonna add to the amount that you deposit in your account. So now the current balance that you now have is the equity. So that's what equity means. So we're gonna move to the next one, which is take profit. Some of you would have heard of the word take profit. Is a word that is being used in trading 247. There's no how you cannot do without the word take profit because it's very important. So let me quickly explain what take profit means in forex trading. Take profit is a term that refers to the predetermined level at which you set an order to automatically close a trade with a profit. Let me come again. In forex trading, take profit is a term that refers to the predetermined level at which you set an order to automatically close a trade with a profit. So this is like now, let me explain, let me show you what take profit means on a live chart. So let's say this is my chart here, and I took the trade from this level. I set my stop loss here above there, and then this is where I want price to, this is where I want to leave the market, somewhere around this zone. I want to leave the market here. I want the market, if this trade goes in my favor, I want it to stop in profit at this zone. So this zone here is my take a profit. So I'm going to also explain what stop loss is in when we get to that. So this is my take a profit here. I'm entering the trade from here, and this is my take a profit. So I want the the market, the broker, to automatically take me out in profit at this zone. So that is what take profit means. Yeah. So like I said, take profit, this is often abbreviated as TP. I don't know, some of you, if you are in my Telegram group and let's say I dropped a signal and I said entry, and let's say entry, I want you to enter the trade at 0.67152, and then I put TP. Let's say I want to the TP to be 0.67146. So now when you see this in any signal, you see TP. TP means take profit. So when you are activating a trade on your MT5 or MT4, you are going to set the TP. So you are going to set the TP that you want to use on that trade. So take a profit, the abbreviation is TP. So let's look at why take profit is very important. Okay, take profit is important for several reasons. Number one, profit lock in. Sorry if I'm too fast, I'm going to be dropping a link to this video on the group so you can still go and rewatch it, so you can grab the ones that you are not able to grab here. So number one, why take profit is very important. Number one is profit lock in. So this allows you to secure profit before the market reverses and potentially erase your gains. Let's say, for example, you are on a trade, you did not set your take profit, and then the price got to where you intended for it to go to, and then it was supposed to take you out of the trade immediately. Price got to that level, but because you did not set your take profit on your on the MT5 or MT4, so now price now reverse against you. Sometimes price might just, after price got to that level, it might be that that particular place that you marked as your take a profit is where liquidity was lying. So price have now gone to clear out liquidity and now reverses against you. So you will now discover that the trade that you were once in profit has now gone against you, which is a negative, and then it might even go back and hit you and stock you out of the trade with loss. So that is one of the disadvantages of not setting take profit on your trade. um Number two, in terms of risk management. So one of the reason why take profit is very important is because of risk management. We see, take profit helps you to maintain a positive risk to reward ratio by ensuring that your potential profit is greater than your potential loss. And let's look at the third one, emotion control. Why take profit is very important. The third one is emotion control. So it removes the emotional aspect of manually deciding when to close the trade. So you can see why it's very important. So it removes the emotion. Let's say you do not set take a profit, and then price got to a certain place, and then you are now contemplating whether to close the trade or not. And instead, meanwhile, if you have set your take a profit, you have decided that this is where I want to use as my take a profit. Once price get there, it doesn't care about any, it just take you out in profit. So while you are now having emotion and trying to figure out or decide then whether you should close the trade or not, price might just do anything instantly and just reverse against you, and you might close the trade in loss. So which is not really cool. um let's look at also setting, when you are setting your take profit. So you must look at this thing when setting your take profit. So when setting your take profit level, consider factors like your trading strategy, the current market conditions, and technical analysis. So there must be a reason why you are setting your take profit there. You don't just set take profit because you just feel like setting it there. There should be a, a strategy that you are using that allows you to, you know, put your take profit there. So which is also technical analysis. So that should be the factor why you are setting your take profit there. So um it might also be because of a certain chart pattern that you see on the chart, or your technical indicators. Some of you that is using indicators, you know. So it might be maybe your the indicator you are using um, gave you a particular signal that you should use that as your take profit. So let's summarize the whole thing. So number one on this summary is take profit is an order to automatically close a trade when price reaches a specific level. I'll come again. Take profit is an order to automatically close a trade when the price reaches a specific level. So the second one is it is used to secure profits and manage trades without constant monitoring. So let's say you are somebody that is still keeping your 9 to 5, you are always busy. So you can just set your trade and set your take profit and go and do anything that you want to do and come back. And if your if your analysis was correct, you know, if it goes in your favor, you are going to come back and see your profits lying down lying down in your account. So that's one of the benefits of setting take profit. So so the third one, setting take profit is important for profit locking, risk management, and also emotion control. Like I said, it also monitor, it also help to um, reduce emotional control. So also consider your trading strategy and market analysis when placing take profit. I've said this before. Take profits can be used alongside stop loss. So like take a profit and stop loss, they work hand in hand. So there's not how you are setting your take a profit that you not set your stop loss. So they work hand in hand. If you want a proper risk management, you should always have a certain level of take profit and your stop loss. So they are very, very important. So I'm going to be looking at what we call stop loss. Stop loss, like I said, the same way take a profit is TP, stop loss is SL. So like now in this place, let's say I drop a signal and then I put the entry, the TP, and then I want to put the stop loss. So the stop loss, I'm going to be writing it as SL. SL means stop loss. So this is my stop loss, and let's say I input the number. So if you if I let's say for example somebody gave you a signal like this, so what you do is that you would go and you use this one. The entry is where you want to enter that particular trade from. So you are going to use this one as the entry, then you copy this number and paste it there as your TP, and then the SL, then you execute the trade. So if you are a type that you are entering a limit order, so this is how you are going to enter it. So you place it there, and once price gets to that zone, it's going to activate the trade on this entry, and then this will be your stop loss and this will be your take profit. So that's how it works. So let me explain to you the meaning of stop loss. In forex trading, a stop loss is a term that is used to describe an order you place with your broker to automatically close a trade at a specific price in order to limit potential losses. I've said this. It is Stop loss is a term that is used to describe an order you place with your broker that automatically close a trade at a specific order limit. So this also help to minimize losses. So I'm gonna also talk about why stop loss is important. The importance of stop loss. Stop loss is stop loss is very important because of risk management. I always say this. Risk management, I always emphasize on risk management a lot. So risk management, it is a crucial tool for managing risks by defining the maximum amount you are willing to lose on a trade. It is a crucial tool. It is a tool on its own. It is a crucial tool for managing risks by defining the maximum amount that you are willing to lose. And then the second one is emotion control. Emotion control. It prevents emotional decision making. It prevents emotional decision making during times of market volatility. So trader might otherwise be tempted to hold onto a losing trade in hopes that the market will turn around. So this is also a really, really big killer in trading. If you are a trader that is not sure about yourself or doesn't know proper risk management, let's say this is your stop loss here. For example, let me use this. Let's say price got to your POI. So this is where you wanted price to sell from, and then when price got to that place, price started to sell a bit, and then it sell to this zone. Then it reverses and took out this other high here, and then it came down again. I'm just giving you an example. And so you are hoping that this price, because this price took out this liquidity, that this will be a strong high. So instead of that, price was now misbehaving, doing somehow, and then price was not going up, approaching your stop loss, and then you are not scared. This is your stop loss. This is your stop loss, and then because you are scared, I don't want to lose the money that is already active here. Everything that is on this zone is your stop loss. So because you still believe that your analysis will still drop, so you are now shifting your stop loss. You are now shifting your stop loss, shifting it, and price is still going, trailing your stop loss, and you're like, is my village people following me? And eventually, because you did not set your stop loss initially, you see that price will now come and take you out, and you are going to lose more than what you wanted to lose, because this is actually where to you wanted it to be your stop loss. Now look at how much you have now lost because you are shifting your stop loss till you can no longer bear it again, and you will not lose you will not lose a lot of money that you didn't bargain for. So that is why you see that it is important to always set your stop loss, and that should be your stop loss. You must always consider everything before you even set stop loss before. And if price choose to do anything otherwise, you will just lock up and look at what price is trying to say again. That's why it is good that you always trade what you see, not what you think. So as you see that price did not respect your stop loss before, you will now wait and look at what it is trying to say. Then you will now trade alongside with what you are seeing. So that's the secret. Because there's no 100% in this. There's nobody that gives you on that has 100% analysis. Everything is under probability. So that's just how it is. That's why we have stop loss to help us. So I talk about emotional control. Then protecting capital. Okay, this helps by limiting losses. Stop loss helps to preserve your trading account for future opportunities. That's why I always say that you don't put your egg in one basket. You don't put your egg in one basket, because if you go and start shifting your stop loss and putting your egg in one basket, risking your entire account on one trade, you are gonna lose out, because there's always thousands of opportunity that's gonna present itself again in the future, and you can take another good trade and cover up your loss. So there's always opportunity in the market. That's why you don't have to start being eager that you want that particular one to play out on by all means. That's not how it's done. So setting stop loss. Let's talk about setting stop loss. um um when setting a stop loss level, consider factors like your risk tolerance. One, your trading strategy. Two, and technical analysis. Some traders place their stop loss beyond key support or resistance level to allow for market noise, while others use technical indicator to set their stop loss level. You know what you mean by market noise? At times, normally this is where price, see, normally this is high the highest head point of this zone here. So this is where price is supposed to react from. Like, this is price is not supposed to push above this place, because this is like a strong resistance level. So so let's say price now retrace back to that zone from here. So let's say price retrace back to that zone. After price retrace back to that zone, it's supposed to react from here and start selling. doing something like this. But instead, when price got to that zone, instead when a price got to that zone, it now started doing some kind of shaky, some trickish moves, and then it now went above this high, and then immediately came down to do a break of structure. So so now what price did here was that price came to come and take out liquidity, to come and stock out some people that set their stop loss here. So it came to that zone and took them out. Then it now gave it the more force to pull down. So that is the what you call like market noise, like liquidity hunts. You know, so liquidity is what moves the market. Stop loss, where people are setting their stop loss, that is where price moves, hunting for it, hunting for where normal retail traders are setting their stop loss, then take them out, then use it as a fuel to push further to the direction that it's intended to. So let's look at sorry sorry about that. um so trailing stops. So a trailing stops is an advanced type of stop loss that moves as the price move in your favor. I'll come again. Trailing stops. A trailing stops is an advanced type of stop loss that moves as the price moves in your favor. This allows you to lock in profit while giving the trades room to breathe if the market moves in your favor. So I'm gonna try to summarize the whole thing. A stop loss is an order to automatically close a trade at a specific price to limit potential losses. I'll come again. A stop loss is an order to automatically close a trade at a specific price to limit losses. So the second one is it is a crucial risk management tool that defines your maximum loss on a trade. So it defines your maximum loss on a trade. So the third one is setting a stop loss is important for the emotion control and protecting trading capital. It helps in controlling of your emotions. So emotion is like one of the key factor that you must consider when you are trading. You must know how to control your emotion to be successful in the trading business. So consider your risk tolerance, strategy, and technical analysis when placing stop loss order. And then the last one is stop loss orders are often used alongside take profit orders for the comprehensive risk management. So you cannot say you are only choosing, you are only having a take a profit without having stop loss, or you are only having stop loss and not having take profit. Like they work hand in hand. If you want, if you are following your risk management while you are setting your stop loss, you must make sure that you are setting your take profit. So they work hand in hand. And so we are going to look at what we call order type. So I think this is going to be the last topic we are going to be looking at today, which is called order type. So let's dive into it. In forex trading, understanding the different types, the different order type is essential as they determine how and when your trade are executed in the market. So each order types serve a specific purpose and helps you manage your trades more effectively. So here is a simplified explanation to the main order type in forex trading. So number one, we have the market order. So this meeting is going to be ending by in 15 minutes time, by 15 minutes, and so I'll just try to round up everything before that time. So I said market order. A market order is the simplest type of order. I know some of you knows the meaning of, everybody should know the meaning of order. Let's say you are ordering a goods now. For example, you saw something in one of this online store and you want to order it. So the same thing in trading, we call it order. The same thing in trading. So when you are taking a trade, you are entering any trade, it's an order also. It's called order. So a market order is the simplest type of order. So you are instructing your broker to execute the trade immediately at the current price. Let me show you an example on the chart. Okay, let's say you saw price. So you saw price broke this structure. Yeah, you saw price break this structure here, and then after price did the break here, and price went back to this zone here to fill up the imbalance that is around this zone. If I switch my lower time frame, you are going to see that there is a gap there. With time, when we get to the technical analysis, you are going to understand all these terms I'm saying. So when price did this break of structure here, so when price did that, so price came down a bit, and then price returned and filled up the imbalance, or you can call it fair value gap around this zone. So price came to fill up that fair value gap, because there are, if when we start the technical analysis, you are going to know that there's gap are not supposed to be in the chart in the market. So price went back to fill up that imbalance. Then you now saw this move. So if this is part of your strategy, you can enter an instant order. You can open your MT5 or MT4 and enter an instant order to buy from here immediately, to sell from here. Then you sell till wherever you are done, you feel like you want to exit, depending on the style of trading. So that is an example of market order. It's an instant market execution. So the second one that we have in the market order, we have the limit order. So a limit order is an order to buy or sell currency at a specific price or better. If the market reaches or exceeds the specific price, the trade will automatically execute. So This order type is used when you believe that the price will reach a certain level before continuing in the original direction. So let's say, for example, now, like this one now that I'm doing now, let me switch to my 15-minute time frame so you can have a better view of what I'm trying to say. Let me take this out. So let's say you see this zone now that I've marked here. This is my order block. So let's say I believe, I perceive, or I believe, based on my strategy, that price will come to this zone before selling because there's a break of structure here to the downside, and I believe that price is going to find its way up here before selling. So what I'll do is that I'm going to set my limit, my sell limit here, then I'll set my stop loss around this zone, and then my take profit will be around this zone. So now this um is what you call limit order. You called out limit order because you set it down and you leave it and price. If your analysis is correct, and price gets to that level, it's gonna tap you inside the trade automatically because that's what you set down. So it's far more, it's different from markets, from market order. So there's what you call so there are types of limit order, buy limit and sell limit. So buy limit is placed below the current market price, anticipating a potential drop below, or anticipating a potential drop followed by an upward movement. So why sell limit? Sell limit is placed above the current market price, expecting a potential rise followed by a downward movement. So if you set your sell limit here, so if buy, if you wanted to buy, so buying is supposed to be somewhere around there. If I want to buy, I'm going to be buying. Okay, let's say I want, if price gets break this high here, because this is a high. If price breaks this high here, that is gonna give me an indication that price have done a market structure shift. One, two, three. Okay, that's the retracement. Okay, so if price break this high here, so that has given me, and then it will come down somewhere around there and then break this high again here. So this has given us a upward movement. So let's say if price broke that high there, so this high was broken like this, so this is a market structure shift, and then so that has given us sign that price is about to buy, so it can buy to this zone, and there are a lot of liquidity that's lying above all this zone, like here, here, and then most of all there's a fair value gap here. Price will always come and look and try to fill up any fair value gap or imbalance, so that's how the buy limit and the sell limit looks like. um there's also what you call stop order. A stop order is an order that becomes a market order when the specific price is reached. It is used to enter the market when it is moving in a specific direction. I'll come again. A stop order is an order that becomes a market order when the specific price is reached. It is used to enter the market when it is moving in a specific direction. So we have buy stop and we have sell stop. So let me explain the meaning of buy stop. Buy stop, because of time, I will not be explaining everything in detail because we have less than 10 minutes before this class is going to go off. Okay, we have 6 minutes. Yeah. So buy stop, it is placed above the current market price, anticipating a breakout and continuation of an upward movement. So a sell stop placed below the current market price, expecting a breakdown and continuation of a downtrend. So let me see if I can explain this. Anyway, also let's say for example now, price break this place here. So now, and you have already, okay, so now you set that, okay, if price should get to this place, if price should get to this place, that means like you already, because of the force that's coming down, you know that there is enough volatility in the market at that moment. So now price does this, so you now sense that price might continue buying, and then you set your your, no, might continue selling rather, then you set your sell limit here, and then and it continues selling. So I mean sell stop, then the same thing the other way around for the buy stop. So let's look at stop loss order. Stop loss order, a stop loss order is used to protect your trading capital from excessive loss. We have done this before. It is an order to close a trade at a specific price. So let's look at, let's summarize the whole thing. So market order are executed immediately at the current market price. So like I said, market orders are executed immediately. They are executed immediately at the current market price. Limit orders are executed at a specific price or better. Stop loss orders become market order when a specific price is reached. Stop loss orders become market order when a specific price is reached. Stop loss and take profit orders manage risks and lock in profit. Stop loss and take profit manage your risk, and lock in your profit. While trailing stop order moves your stop loss as the market moves to in your favor. And GTC is order remains active until manually cancelled. So the next one we are going to be looking at forex analysis, and we're going to try to cover some. We're going to try to make this class as fast as possible. So we're going to enter the technical analysis. I know some of you are eager to reach that part, but there's no how I can go to that part without explaining all these basic stuff that you're supposed to know. So when I get to that part and anybody is asking me this and that, or and asking me something that I've already explained here, I'm not going to answer that person. I'm not going to go back because the person didn't pay attention to this. So some of you that is thinking that you just want to jump into the technical analysis without knowing all these parts is, you are actually not doing yourself any good. So the class is going to end now. um Good night, and try to make your own personal research so you can be good at what you are doing. Bye.